Learning outcomes. After studying this module, you shall be able to know the meaning of receivables and cash, learn various aspects of receivables and cash management, analyze the impact of various policies on the receivables and cash on the profitability of the company, evaluate the various proposals of receivables and cash management. Introduction. Receivables and cash are very important part of current assets and should be very well managed. When goods are sold on credit and the payment for it comes after some time, debtors are created. There must be a proper management of these debtors. It must be ensured that there is a timely collection and large funds are not blocked for long periods. Cash is absolutely essential for any business. Finance manager must see that there is liquidity on all parts of the organization, and at the same time cash is not idle. Idle cash implies losing interest and therefore the opportunity cost. Cash is needed in an organization for transaction needs, meeting day-to-day expenses and other payments of debts. Speculative needs. Hold cash to take advantage of profitable opportunities. Precautionary needs. To provide safety against unexpected events. Receivables management. When a firm sells its product or services on credit and does not receive the cash immediately, trade credit arises. A firm sells goods on credit to attract the customers. These payments, which shall be received in the future, are called trade debtors and form part of current assets. There are certain limitations when the goods and services are sold on credit by the firm. The following are some of these. 1. There is an element of risk. It might be possible that debtors default in making payment and therefore loss arises due to bad debts. Number 2. The amount gets blocked in the form of investment in debtors and the firm has to bear the interest cost on increased investment. Number 3. There is increase in cost due to administration and collection of debts. In spite of the above limitations, the firm sells goods and services on credit because of the following benefits. 1. There is an increase in sales volume. More customers buy goods if there is no immediate cash outflow. Number 2. There is increase in profits because margins on credit sales are higher than on cash sales, or one can say no cash discounts are required to be given. Number 3. One can meet competition by offering better credit facilities than those offered by the competitors. So long as the benefits outweigh the risk and cost to the firm, it offers goods or services on credit. Objectives of receivables management. Firms offer credit to customer for a number of reasons. But the ultimate objective is to maximize the return on investment in receivables and minimize risk of bad debts. The finance manager should follow such policy through which cash resources of the firm can be fully utilized. Management of receivables creates a trade-off between liquidity and profitability. Thus, the ultimate objective of receivables management is to maximize the sales so as to maximize the profit. Now you see this graph. If the firm is following a strict credit policy, what happens? The profitability is low, and as it becomes more and more liberal, the profitability increases. However, what happens to the cost? If the firm is following strict credit policy, the liquidity is more, but as it is liberalizing, you will observe that the cost benefits go on decreasing, but after a point they start increasing. So there is a fine balance between profitability and liquidity. Aspects of receivables management. There are 4 major aspects of receivables management. 1. Formation of credit policy. Number 2. Credit control. Number 3. Credit evaluation. And number 4. Monitoring the receivables. Formulation of credit policy. The credit policy of a company can be regarded as a kind of trade-off between increased credit sales leading to increase in profit and the cost of having larger amount of cash locked up in the form of receivables and loss due to the incidence of bad debts. The credit policy adopted by a company is considerably influenced by the practice followed by the industry, particularly in a competitive market. The term credit policy encompasses the policy of a company in respect of the credit standards adopted, the period for which credit is extended to the customer, and the cash discount offered. The various variables associated with credit policy are credit standards, credit period, cash discount. These variables underlying a company's credit policy influence sales, the amount locked up in the form of receivables, and some receivables becoming bad debts. While understanding these variables, it is assumed that firms have unutilized capacities and no additional fixed cost would be required to be incurred when sales volume increases. Credit standards. Before deciding whether to extend credit to a customer or not, it is worthwhile to first find out the paying capacity of the customer. If the paying capacity of the customer is good, he is rated as good. Customers are rated as high, good, fair, and limited in the descending order of credit rating. Setting credit standards means deciding on the type of customer to whom credit is to be extended. If credit standards are strict, credit is extended to high and good rated customers only. This would mean fewer sales, less profit, but also less risk. The amount of investment in debtors would be less and chance of bad debts will be removed. On the other hand, liberal credit standards would imply extending credit to customers with fair rating or even to customers with bad ratings. Sales will increase, but the risk of bad debts will also increase. Further, additional amount of funds will be blocked in receivables and there will be increased expenses on the collection front. So if the increased profits compensate for these additional expenses, the firm may set liberal credit standards. Now let's look at the first illustration. The current sales of company are rupees 2 lakhs with customers having high and good credit rating. With sub-liberalization in credit standards, sales can go up to 2.4 lakhs with 2/3 of the customers good and high rated while 1/3 are fair rated. If the contribution is 20% and bad debt chances on fair rated customers is 10%, should the company liberalize credit standards? Now let's look at the solution. Increased contributions will be 20% of increased sales. That is, increased sales are 40,000 multiplied by 20% is 8,000 is the increased contribution. Sales to new customer is 1/3 of 2.4 lakhs which is 80,000 and bad debt lost only to the sales of new customers at 10% is 80,000 into 10% 8,000. So if we ignore the additional funds blocked with increased sales, then also the profit on increased sale is offset by bad debt loss. So the company should not liberalize credit standards. With cost of funds and increased collection expenses, it will become a loss proposition. Credit period. The credit period refers to the length of time allowed to customers to pay for their purchases. It generally varies from 15 days to 60 days. If a firm allows, say, 30 days of credit with no cash discount, its credit terms are stated as net 30. Lengthening of credit period pushes up sales because existing customers purchase more and new customers are attracted. But this implies more involvement in receivables and more bad debt losses. A shortening of credit period will lower sales and investment in receivables, but also decrease the bad debts losses will also decrease. Example, let annual credit sales be 6 lakhs. Extending 30 days credit period implies that the average debtors would be equal to 30 days sale, which is 6 lakhs divided by 360 is the per day credit sale, and since we are allowing 30 days credit, so the amount involved in debtors is 50,000. If credit allowed was 45 days to achieve a sales of 6 lakhs, average debtors would be equal to 45 days sale. Now assuming sales will remain same, the debtors would be 45 into 1666.67 is 75,000. Now this additional investment in receivables is 15,000 without generating additional sales or profit. So in this case, there is no point in extending the credit period from 30 days to 45 days. Cash discount. Firms generally offer cash discounts to induce prompt payment. Credit terms reflect the percentage of discount and the period during which it is available. For example, credit terms of 110 net 30 means that a discount of 1% is offered if the payment is made by 10th day. Otherwise, full payment is due by 30th day. In this case, the cost of funds to the firm is 18% per annum because 1% discount reduces credit period by 20 days. In cash discounts, the incremental benefits arising out of additional sales which are due to reduction in cost of funds blocked in the form of receivables and reduction in bad debts. The benefit should be compared with discounts offered. If the benefits are positive, cash discount should be offered. Credit control. The purpose of collection policy is to achieve timely collection of receivables so that funds locked up in receivables are released and bad debt losses are minimized. The collection program consists of monitoring the state of receivables, dispatch of letters to customers whose due date is approaching, telegraphic and telephonic advice to customers, threat of legal action or legal action against debtors to recover overdue accounts. Company must be careful that a rigorous collection policy might irritate the customer and may result in reduced sales. This also has a negative impact on the reputation of the firm. As is clear from the graph showing that if you are increasing the control over the collection, in that case your collection cost goes on increasing. And if you look at the bad debt losses, they go on decreasing, but after a point certain saturation point is received, after which any amount of increase in collection cost does not result in decrease in bad debt losses. The initial collection expense may have no significant impact on bad debt losses, but a little increase in expense will reduce bad debt losses. Then a saturation point is reached when bad debts cannot be further reduced by incurring additional collection expenses. Credit evaluation. Before granting credit to a customer, a firm seeks information on the credit worthiness of that customer. Credit evaluation of the prospective customer involves obtaining information from which the financial capacity as also the paying habits can be evaluated. But in obtaining this information, certain costs are involved. Monitoring receivables. There are three ways in which receivables can be monitored. These are as follows. 1. To calculate the average collection period or ACP. One of the common methods to monitor the receivables is the collection period or number of days outstanding receivables. The average collection period may be the amount of credit extended to the debtors. This can be calculated using the following formula. Average collection period within bracket ACP is equal to average receivables oblique credit sales per day. For example, credit sales per day is rupees 2000 and average receivables are 50,000. This implies a collection period of 50,000 divided by 2000 equal to 25 days. If average receivables are 80,000, then collection period would be 80,000 divided by 2000 is equal to 40 days. Aging schedule. Aging schedule is another technique available for monitoring the receivables, and this is known as aging schedule. The age-wise distribution of receivables is determined. Older the receivables, lower is the quality and more chances of default. For example, the receivables can be classified as follows. You look at the first column, we are defining the age of the debtors. In the second column, you see the amount or percentage of total outstanding receivables. Now 0 to 30 days, 40% receivables are there. 31 to 60 days, 30% receivables are there. Within 61 to 90 days, 20% receivables are there. 90 to 120, 7%, and 120 and above, 3%. By comparing the aging schedule of the firm with other firms, or by comparing with the previous period, one can determine whether things are in control or there is a reason to worry. In the above example, debts older than 120 days may be written as bad debts. Accounting ratios. Two accounting ratios that may be calculated on a regular basis to find the changing pattern of receivables are debtors turnover ratio and average collection period. These ratios may be compared with industry standards and with past ratios of the firm. If the ratios are better than industry, it is healthy. But if we are giving collection period of 60 days, whereas industry norm is 30 days, it is cause for worry. Cash management. Cash should be very well managed in any organization. For this, the first step is to estimate the requirements of cash. Cash flow statements and cash budgets are a good aid to estimating cash requirement. Cash management refers to management of cash balance and the bank balance, including short-term deposits. Cash management control aspects. The finance manager must ensure that divisional managers do not retain cash in excess of their day-to-day requirement. For this method have to be employed to speed up the mailing time of payments from customers. There are two methods to speed up collection process. One is concentration banking. In this system, the company establishes a number of strategic collection centers in different regions instead of a single collection center at head office. Payments received by different collection centers are deposited with their respective local banks, which in turn transfer all surplus funds to the consideration bank of head office. Number two is lockbox system. The purpose of lockbox system is to eliminate the time between the receipt of remittance by the company and the deposit in the bank. Under this arrangement, the company rents the local post office box and authorizes the bank at each of the locations to pick up remittances in the boxes. Customers are built with instructions to mail their remittances to the lock boxes. The bank picks up the mail several times a day and deposits the check in the company's account. Thus, the lag between receipt of checks and deposit in the bank is eliminated. However, the bank charges for the services and lockbox system has operation cost. Lockbox system is not appropriate where average remittances are small. It is best to compare the cost with the marginal income that can be generated from the released funds. If income is more, the system is profitable. Reduce the time when payment remain uncollected. The time during which the payments remain uncollected has to be sped up. And speed up the movement of funds to disbursement banks is also necessary. Playing the float. Availability of cash can be maximized by playing the float. In this, a firm estimates accurately the time when checks issued will be presented for encashment and to estimate the time of collection of checks deposited by it in the bank. In case collection time is less than the encashment time, the firm can utilize the float period to its advantage by issuing more checks. Suppose a firm deposits 20,000 checks in its bank per day and issues similar amount of checks per day. It takes 3 days to encash checks issued by it, but bank gives credit for checks deposited by them in 2 days. This would mean that bank shows a credit balance of rupees 20,000. In firm's bank book, it will show zero balance. Different kinds of float. Number one is billing float. This is the time between the sale and mailing of the invoice. Mail float. The time when a check is being processed by post office, messenger service or the other means of delivery. Number three, check processing float. Time required for the seller to sort, record and deposit the checks after it has been received. Number four, banking processing float. Time from deposits of the checks to the crediting of funds in the account. Cash management models. Normally we have two types of cash management models. Number one is inventory type models, which is named after William J. Baumol's EOQ model, applies equally to cash. Number two is stochastic model, when demand for cash is stochastic and not known in advance. William J. Baumol's model, as per it, the optimum cash level is that where the carrying cost and transaction costs are the minimum. This is given by the formula C is equal to under root of twice into U into P divided by S. While U is annual cash disbursement, P is fixed cost per transaction and S is the opportunity cost of 1 rupee per annum. Miller or cash management models. When changes in cash balance occur randomly, the application of control theory serves useful purpose. This model is one of control limits models. This model is designed to determine the time and size of transfers between an investment account and cash account. In this model, control limits are set for cash balances. These limits may consist of H as upper limit and Z as the return point and 0 as the lower limit. Now this can be clearly seen in the graph given below. When the cash balances reaches the upper limit, the transfer of cash equal to H minus Z is invested. When it touches the lower limit, a transfer from investment to cash account is made. When cash balance stays between H and Z or Z and 0, no transactions are made. The high and low limits of cash balances are set up on the basis of fixed cost associated with securities transactions, opportunity cost of holding cash and degree of likely fluctuation in cash balances. Cash budget preparation. Cash budget is an estimation of the cash inflows and outflows for a business for a specific period of time. Cash budgets are often used to assess whether the entity has sufficient cash to fulfill regular operations and or whether too much cash is being left in unproductive capacities. The firm has to take suitable steps to generate cash by borrowing from its bank or by introducing capital to avoid liquidity problem. You can see the example of cash budget through this illustration. Summary. When a firm sells its product or services on credit and does not receive the cash immediately, trade credit arises. These future payments are called trade debtors and form part of current assets. The ultimate objective of receivables management is to maximize the sales so as to maximize the profits. There are four major aspects of receivables management: formulation of credit policy, credit control, credit evaluation, and monitoring receivables. The various variables associated with credit policy are credit standards, credit period, and cash discount. The purpose of collection policy is to achieve timely collection of receivables so that funds locked up in receivables are released and bad debt losses are minimized. Before granting credit to a customer, a firm seeks information on the creditworthiness of that customer, called as credit evaluation. There are three ways in which receivables can be monitored: calculation of average collection period, aging schedule, and accounting ratios. Cash should be very well managed in any organization using cash flow statements and cash budgets. The concentration banking and lockbox system are the two methods to speed up collection process. There are two models: inventory type model and the stochastic model for cash management.